Gold isn't rising anymore. It's repricing, and the market structure is screaming it before the headlines catch up. And the weird part is how hard certain voices are working to make you believe this is just a mood swing, a fear trade, a temporary spike that'll fade the moment a central banker clears their throat. But the mechanism driving this move doesn't care about anyone's narrative because it isn't emotional. It's math, it's positioning, it's supply access, and it's the kind of pressure that shows up first in the plumbing of the market, not in a TV chyron. Stay with me, because by the end of this, you're going to have a clean, near-term roadmap for what matters this week, what levels can change the tempo, what would confirm a push toward the kind of upside people laugh at, and what would break the whole setup fast. Here's the conflict. Gold is the asset institutions love to talk down in public and quietly respect in private. In public, it's barbarous relic. It doesn't yield, just a hedge for nervous people. In private, it's a reserve tool, a collateral tool, a geopolitical tool, and in certain moments, a problem-solving tool. That split personality matters because it creates a constant incentive to frame every rally as irrational. If you can label the move fear, you don't have to admit its structure. You don't have to admit its persistent demand. You don't have to admit that the world is pricing a different kind of risk, currency risk, policy risk, geopolitical risk, without waiting for a dramatic headline. And it's not just rhetoric. Risk committees don't like owning the thing that sounds old. Fund managers done a tea-like explaining why they hold a non-yielding asset when their benchmark is screaming for duration or growth. Banks done a tea like retail investors realizing the difference between a paper price and the cost of accessing metal under stress. So you get the same pattern. A grind higher gets dismissed until it's too obvious to dismiss. Then the story suddenly changes to, well, of course, but it's overextended, and that's when the real whipsaw starts. Now zoom into the price action right now. This isn't a lazy drift. This is the behavior of a market that keeps finding buyers even when the macro backdrop tries to scare them off. Gold has been trading like a breakout that refuses to cool off, pressing toward big psychological numbers that used to sound insane in normal conversation. And when you see price leaning into a major round level, something like a $5,000 handle, people fixate on the number like it's mystical. It isn't mystical, it's just where positioning, options, and psychology collide. It's where short sellers get nervous. It's where hedgers get active. It's where funds start thinking in quarterly reports, not daily candles. And it's where the market decides if it's going to do the boring thing or the violent thing. But here's the detail most people miss, and this is the hidden hinge of the whole story. When the curve, the flow, and the volatility all lean the same way, the spot price stops being a vote and starts being a constraint. In other words, the screen price becomes the result of forced behavior, not opinion. That's why this can run farther than fair value models suggest. It is why $7,000 stops being a meme and starts being a possible print in a world that doesn't get to choose its constraints. Let me translate that into plain language. There are two gold markets people confuse all the time. There's the price on the screen. Futures, forwards, paper exposure, leverage, hedging, all the machinery that can move huge nominal amounts quickly. Then there's access to physical metal, inventory vault flows, delivery preferences, the logistics and financing that determine how easy it is to convert I own gold exposure into I can source metal without paying a premium or waiting. Most of the time, those two worlds track each other closely enough that people stop thinking about the difference until they don't. And when they don't, that's when the real pressure starts. This isn't a cartoon conspiracy. You don't need secret meetings to explain it. You only need incentives. If you're a large participant, you manage risk with instruments that are liquid and standardized. That means futures and options. If you're an industrial buyer or a sovereign allocator, you care about reliability and settlement and ownership structure. If you're a refiner or a logistics firm, you care about lead times and bottlenecks. If you're a bank, you care about financing and balance sheet. Those incentives don't always point in the same direction. And when they diverge, the divergence shows up first in the term structure, the way the market prices time. So stop staring at spot for a second. Look at how the market prices time. If the gold curve is in a normal contango, the future is priced above spot because of financing and storage. And the market is basically saying, sure, you can have it later and time costs money. If the curve starts flattening aggressively or under certain stresses, flirting with backwardation, that's the market whispering something uncomfortable. Immediate access is valued. Not because the world ran out of gold overnight, but because the marginal buyer is paying for certainty and the marginal seller is less willing to lend out that certainty cheaply. That's a micro signal that can turn into a macro move because it changes what participants are forced to do. And forced behavior is the whole game. Because if you're short futures, you can be right on your thesis and still get wrecked on margin. If you're long options, you might create hedging flows that buy into strength. If you're a producer hedging output, you might reduce hedging when volatility changes, which changes supply to the paper market. If you're a fund that needs to rebalance at month end, you might have to buy exposure regardless of your opinion of the price. That's why fundamentals alone won't save you from understanding the plumbing. The plumbing is what decides the path. Now stack your proof. Not one argument, not one headline, 5 layers, mechanism, data footprints, institutional behavior, on-the-ground symptoms, and market structure signals. Because this is the only way to stay sane when narratives flip every day. First layer, participation and positioning. When a move is purely emotional, it spikes and collapses as liquidity evaporates. When it's structural, participation doesn't fade. You see persistent activity in the core instruments where big players live: futures volume, open interest trends, the steady appetite to carry exposure even after pullbacks. That's not the whole story, but it's the heartbeat. If the heartbeat stays strong while price keeps pressing, that's not a one-day fear trade. That's a market being reallocated. Second layer, options and volatility, the reflexivity engine. This is where things get spicy, and it's where most people get tricked because they think volatility is just emotion. Volatility is also hedging demand. When implied volatility lifts while price keeps grinding higher, it can mean the market is paying up for protection, yes, but it also means dealers who sold that protection may have to hedge dynamically. Here's the simple version. If someone buys calls, the dealer who sold them is short those calls. To manage risk, the dealer buys futures as price rises. That buying can become automatic. It can become mechanical. It can become a tailwind that doesn't care if you believe in the rally. And if the market moves into a zone where dealers are short gamma, meaning their hedging requires them to buy more as price rises and sell more as price falls, you get a more violent tape. That's why you can see relentless melt-ups and sudden air pockets. Not because everyone changed their mind overnight, because hedging flows changed. Third layer, institutional flows that don't need your permission. Here is the uncomfortable truth. A portion of gold demand today doesn't behave like a trade. It behaves like a reserve decision. Central banks and sovereign institutions don't think like your broker app. They think in decades, in political stability, in settlement infrastructure, and currency diversification. When that bit is present in the background, dips get treated differently. They don't need to feel good about the price. They need to feel good about the exposure. And that kind of demand changes the floor. It doesn't make gold go up every day. It makes gold harder to kill. Fourth layer, vault optics and where liquidity actually sits. You don't need to know every private shipment to understand stress. You watch the visible footprints, vault holdings trends, changes in reported stockpiles, the way the market talks about availability, and the way premiums behave when people try to source. When those signals tighten, price discovery changes. The market becomes less about what should gold be worth and more about how much do I pay to ensure I can get it when I need it. And that shift can happen quietly, then suddenly. Fifth layer, cross-market and currency context. Gold isn't just an isolated commodity, it's a mirror held up to currency confidence and real rates. If the dollar strengthens, gold can still rise if the underlying driver is not weak dollar, but systemic hedging or reserve diversification or geopolitical settlement risk. That's why lazy correlations fail during regime shifts. Gold can trade like a currency, like a commodity, and like a volatility hedge, depending on what the world is stressed about. When you see gold holding up even as the macro tape tries to pressure it, that tells you the marginal buyer is not the same as last cycle. And that is not the part that matters. It is what that forces everyone else to do next. Now, the calendar, because the market doesn't move in a vacuum. This is happening into a window where liquidity thins, and positioning matters more than opinions. Late January is a pressure point, month-end mechanics, policy event risk, and the subtle reality that big funds and desks have to show their books in a way that looks responsible. When you combine that with a major psychological level and active options positioning, you get a setup where a small push can create an outsized response. This is the part that mainstream commentary almost always misses, because it requires you to think like a market maker, not like a pundit. Here's what "why now" really means. If gold is pressing toward a big level into a month-end window, funds that are underweight and benchmark aware face a choice. Chase late and hope it calms down, or buy exposure strategically before the window closes. If volatility is lifting, option hedging flows get more sensitive to price changes. If policy expectations are in flux, rates can swing and create sudden cross-asset shocks. That cocktail makes the tape more reflexive. And in reflexive tapes, levels matter more because levels are where forced flows cluster. So let's talk about the $7,000 idea in a way that doesn't sound like carnival barking. A $7,000 print sounds outrageous if you assume gold is priced like a stable commodity with a stable marginal buyer. It becomes less outrageous if you model what happens when the marginal buyer stops caring about cheap and starts caring about exposure. Think about it like insurance during a storm. Insurance is always too expensive right before you need it. Then it's suddenly priceless. In markets, that moment can be triggered by currency stress, policy uncertainty, geopolitical escalation, or a sudden realization that reserves and settlement channels matter more than theoretical yield. If that shift accelerates, gold doesn't need a neat linear path. It can gap, it can squeeze, it can rip through levels because the people who need it aren't optimizing entry. They're optimizing certainty. Now add the structure layer. If the curve tightens and the market puts a premium on near-term access, that can pull demand forward. If dealers are forced to hedge into rising prices, that can amplify upside. If shorts are crowded, especially in paper exposure, margin can force covering. If equities wobble or credit spreads widen, risk managers often rebalance into what they can justify as a hedge. None of that guarantees $7,000, but it creates a pathway where the price doesn't need to deserve the move to print it. It only needs enough participants to be forced into the same side of the boat. And if you want to understand how far that boat can tip, watch this. A market can stay overbought longer than you can stay patient, and it can still punish you even if you're right. That's the paradox of regime shifts. You can have a correct thesis and still get destroyed by volatility. So we're not doing hero worship here. We're doing mechanics and risk. Now I'm going to give you the cleanest bear case. Because if you can't articulate the bear case, you don't have an edge. You have a religion. There are two clean ways this setup breaks, and neither requires the world to suddenly become peaceful and orderly. Break number one, a real rates shock that stays sticky, not a one-day move. A sustained repricing where the market decides policy will stay tighter, real yields grind higher, and the opportunity cost narrative bites hard enough that marginal buyers step back. Gold can absolutely get punched in that environment, especially if it triggers systematic selling from risk parity or other models. You can see a sharp liquidation even inside a long-term bull regime. That's why you don't confuse trend with a straight line. Break number two. A broad risk-off liquidation where gold gets sold, not because it's broken, but because it's liquid. This happens more than people admit. In violent drawdowns, funds sell what they can, not what they should. Margin calls don't care about your thesis. They care about cash. If the rest of the book is bleeding, gold can become a funding source temporarily. That can create a nasty dip that feels like the top, right before the trend resumes. And that's exactly where the emotional manipulation happens. So let's install the psychology shield. Because the market's favorite trick is to make you emotionally mislabel noise as reversal, and reversal is noise. It does it with speed. It does it with headlines. It does it with sudden red candles that feel like the world is ending. Here's how you protect yourself without becoming numb. First, separate your time horizon. If you're watching a weekly regime shift, you cannot let a one-day flush rewrite your brain. Second, understand where forced flows live. If a drop happens on a policy headline but participation stays strong and the market recovers key structure quickly, that's often a shakeout, not a breakdown. Third, define invalidation before the candle prints. If you don't know what would prove you wrong, you'll let the market prove you wrong emotionally, and it will do it at the worst time. And here's the most important part. Volatility is not proof you're wrong. Volatility is the price of being early or being right in a market that's repricing. Gold can whip around violently even if the thesis is correct. You can get a 3 to 5% dump that feels catastrophic and is just a reset in dealer positioning. You can get a gap up that feels euphoric and is just a hedge cascade. If you don't understand that, you'll keep donating your attention and your capital to the people who understand it better. Now, think in two scenarios from here. Not because we're trying to be cute, but because credible forecasting is conditional. Scenario one is the controlled pullback and retest. In this scenario, gold presses into the big psychological zone, draws profit taking, and then pulls back to a clear support region, maybe prior breakout structure, maybe a moving average region, maybe a volume shelf. The key is not the exact number, it's the behavior. You want to see sellers fail to accelerate downside. You want to see dips met with steady demand. You want to see volatility cool without collapsing. That's the healthy consolidation path. It builds energy. It convinces late skeptics. It sets up the next push with better footing. Scenario two is the continuation squeeze with gap risk. This is the path where gold doesn't give you the pullback you want because the market isn't in the mood to be polite. Price pushes through the psychological level with momentum, implied volatility stays bid, and hedging flows start chasing the move. Shorts, especially in leveraged paper positions, start covering into strength, liquidity thins, so each buy order moves the market more. That's when you get air pockets upward. Fast candles, gaps, the kind of tape that makes people feel like they missed it, even if it started months earlier. This is also when your risk goes up because reversals can be brutal and the upside can accelerate, but so can the snapbacks. What confirms scenario two? Not your feelings. Watch the structure. If price breaks and holds above the big level, if pullbacks become shallow and quickly bought, if volatility remains elevated without collapsing, And if participation doesn't die, that's your confirmation. And that's where the real pressure starts, because the market becomes less about who's bullish and more about who's underhedged. What confirms scenario 1? A dip that respects structure, a retest that holds, a rebound that doesn't need a headline. If you see that, the trend can actually become more dangerous on the upside later, because it rebuilds positioning without exhausting buyers. Now let S talk levels in a way that doesn't T pretend we can print exact targets like a fortune teller. The big psychological zone is obvious. Round numbers matter because humans and funds cluster around them, and because option strikes cluster around them. So treat the $5,000 region as a battlefield, not a destination. Above it, sentiment shifts and hedging behavior can change. Below it, a failed attempt can trigger a temporary flush as weak hands and late chasers get shaken. The next layer is your support shelf. Where did the last impulse leg launch from? Where would a pullback still look like a higher low? Those are the zones that decide whether the move is retesting or breaking. And your invalidation level is the one that forces you to admit the structure changed. It's not necessarily if it dips a bit. It's if it loses this zone and fails to reclaim it with urgency. Because failure and reclaim behavior tells you whether sellers are in control or just taking a breath. Invalidation is about who gets forced. If buyers get forced out and can't regain the level, the math changes. Now let's bring the $7,000 upside back into focus with credibility. The honest way to talk about it is as a long tail outcome that becomes more probable if a specific set of signals align. Those signals are not mystical, they're observable. First, persistent institutional demand that treats dips as opportunities, not warnings. Second, curve behavior that indicates near-term access is valued. Third, options and volatility dynamics that create reflexive buying into strength. Fourth, macro uncertainty that keeps real rates from decisively crushing the bid. Fifth, a narrative shift where the market stops debating whether gold should be up and starts debating how much exposure it needs. If those align, the path to $7,000 isn't gold goes up $2,000 in a straight line. It's a series of repricing steps. Break levels, retest, accelerate, pause, then accelerate again, often with violent shakeouts that exist purely to punish impatience. And if you've watched commodities and metals during true structural shifts, you know the pattern. The biggest moves don't feel safe while they're happening. They feel ridiculous. That's why they happen. And this is where skeptics deserve respect, because skepticism is healthy. The institutions you distrust aren't stupid. They know how to use volatility to shake people out. They know how to weaponize headlines. They know how to say, this rally is over, right at the moment liquidity is thin. Because thin liquidity makes moves look more dramatic, and dramatic moves make people emotional. The next detail is what flips the whole setup. If you can identify the difference between a volatility event and a trend failure, you stop being easy prey. Here is a simple checklist you can run over the next week or two without needing to become a full-time quant. 1. Does gold hold above key structure after pullbacks, or does it lose it and struggle to reclaim? 2. Does implied volatility stay firm, suggesting demand for protection and potential hedging sensitivity, or does it collapse, suggesting the market is calming down? 3. Does participation remain steady, or does the move become thin and fragile? 4. Do you see signs of stress in the time price, tightening curve behavior, persistent bid and near-term exposure, rather than just a spot price spike? 5. Do correlated risk assets start behaving like they're under stress, which can either help gold as a hedge or temporarily hurt it through liquidation? That last one is the trap. Gold can get hit in the first wave of liquidation and then lead in the second wave. If you don't know that, you'll keep buying tops and selling bottoms emotionally. Now let's get real about risk, because credibility lives here. Nobody gets to promise you smooth upside. In fact, if gold is truly entering a repricing regime, volatility can increase. That means bigger daily swings. That means more false breakdowns. That means more this is it moments that aren't it. The correct posture isn't bravado, it's humility plus structure. Know your horizon. Know your invalidation. Don't over-leverage. Don't let the market force you into a decision you didn't pre-plan. Because the market doesn't need to beat you on direction to beat you on behavior. So what's the actual takeaway? It is this. Gold as upside case isn't tea a fairy tale when you understand the plumbing. The hidden detail is that the market's structure, time pricing, volatility hedging, positioning pressure, can create forced buying that overwhelms fair value narratives. The calendar matters because month-end mechanics and policy uncertainty can amplify moves. The proof stack matters because you need multiple independent signals pointing the same direction. Participation, vol behavior, institutional reserve logic, vault availability optics, and cross-market context. And the near-term roadmap matters because you don't make money or preserve capital by being vaguely right. You do it by knowing what confirms and what breaks. If we get scenario 1, the controlled pullback and retest, your job is to watch behavior at support and see if buyers defend with intent. If we get scenario 2, the continuation squeeze, your job is to respect gap risk and not let FOMO rewrite your plan at the worst possible moment. In both scenarios, remember, trend signal is the structure and the reclaimed behavior, noise is the intraday drama and the headline whiplash. And if you're the kind of investor who wants mechanics over hype, who'd rather be early with a plan than late with an excuse, you already know this isn't a T about predicting a single number. It S about reading forced behavior in a market that is slowly telling you what the world is afraid to say out loud. Stay sharp. Watch the levels that force transactions and don't let volatility steal your conviction when the structure is still intact. Because if that one level breaks, the math changes.